This conference will now be recorded.
Hello everyone and welcome to Brickwork Ratings presents Masterclass. In this series, based on the feedback received from you at the investor desk at brickworkratings.com, we are starting this exclusive series where we are profiling market experts and their feedback about various topics which is concerning the credit markets now. As you would be aware that given the pandemic situation, many sectors have been showing some recent trends. However, one of the sectors which we felt has been asking for maximum number of inputs is the commercial real estate. And one of the leading indicators in the commercial real estate is also from the fact that the kind of transactions happen there. At Brickwork Ratings, we have been looking at many such transactions. One of the such transactions is in the lease rental discounting. So today we have a very brilliant expert on this topic. We have Mr. MSR Manjunatha. Mr. Manjunatha was the Chief Rating Officer of Brickwork Ratings recently. He has been with ING Vaishya Bank as the Chief Audit Officer prior to Brickwork Ratings and has over more than 30 years of experience in banking sector. So we couldn't expect a much better expert on this topic. And with this brief introduction and with a promise that we'll come back with such kind of interesting sessions for you to keep engaged during this pandemic situation and period, I hand it over to Professor Malina.
Thanks, Satish. When we discuss topics which are relevant in today's times, I thought one of the most interesting topics would be to discuss the product loan against rental discounting and what exactly is happening currently for this product. So I have titled this presentation as COVID impact and unraveling of loan against rental discounting. This presentation will be roughly for about 30 minutes. Now, let us first try to understand what has happened in the post COVID situation. Yes. Can we move to the next slide? All of us have been impacted by the development since the middle of March and ever since India went for a lockdown. Basically, cities have got through the lockdown process. Some areas have been closed down, and as a consequence, various businesses have been impacted. If you look at how they are impacted, the first and foremost is that their customers are impacted. So any business has its customers and it has its suppliers. Both the customers are impacted because they are closed, they are not working, they are partially functioning. Suppliers are impacted. Suppliers are not able to provide you the required inputs, components, raw materials. The whole logistics market has been impacted. The labor force is impacted. In fact, most of us have seen very vivid pictures of labor migration. So as a consequence of all these things, there has been significant loss of production, revenues, and profitability. Since this pandemic is not confined to only India, it has also affected more or less all the countries in the world. Export markets are very badly affected because we are not able to export to those countries which are also reeling under the lockdown. We are also not getting the required materials from other countries because the logistics are affected. So then the picture is of a total desperation for the businesses, at least since the middle of March till now. So that is more or less 3 months are over now. So as a consequence, when businesses lose their revenues, they are no more profitable or not generating any surplus. There is total absence of liquidity with them. So their ability to do any debt servicing as of today is quite badly affected. So this is true of all businesses, and some businesses obviously are more affected than others. I will just give a couple of examples. Now, one thing that all of us very clearly see is the aviation sector. Now, all of us know flights are more or less, international flights are not operating, domestic flights are not operating for more than 2 months. Some skeletal service is going on. So obviously the fleet are all grounded, and as a consequence, their ability to earn revenues, meet all their expenses and overheads, pay salaries to their employees, to suppliers, and then of course later debt servicing is quite badly impacted. So that's a very clear example. A couple of other examples I can give are anything relating to travel, transportation, tourism, like for example hotels, cruise industry, package tours. All these people are very badly affected by the COVID-19 related developments. So how have different regulatory agencies and other authorities uh, responded to this situation? Let us go to the next slide. Now you will see here that most central banks have intervened in different ways. Interest rates have been reduced, liquidity has been pumped in, and more importantly, debt repayment has been postponed or deferred by what is called a moratorium announcements. The Reserve Bank of India made two announcements, one in March and the other in May, explaining that for a period of 6 months there is a moratorium for debt repayment. So neither the principal nor interest need be paid during this period. So everything gets technically deferred by 6 months. So this is what it is. Many of you also may know that this issue is also engaging the attention of Reserve Bank of India, Supreme Court of India in some way. People have gone there to say whether during this period interest should be paid, whether interest on interest should be paid, etc. These are all matters which anyway I'm sure will get sorted out. But more importantly, what we should try to understand at this stage is repayment during these 6 months, whatever was due and falling, is deferred by 6 months. So nothing is going to be waived. Everything has to be paid. But only thing is the payment has got deferred by 6 months. That means for all practical purposes, till end of August, nothing need to be paid. Maybe from September or October, the repayment will start. So this is a temporary relief, but an essential relief that is required by businesses and required by any borrower, for that matter, even an individual borrower. Even if I buy a car or a home using the loan product, then these loans also are deferred, and all that the customer is required to do is approach his banker or NBFC or housing finance company and seek the deferral. So this is something which has happened. Let us go to the next slide. Now you will see that this has affected some products much worse than other products, and according to me, one of the products which is so badly affected is the lease rent discounting. In fact, this is LRD is expanded as loan against rental discounting. This is a very popular product. This product has been there at least for about 15 years in the Indian banking industry, a little more if you compare what some of the private banks or multinational banks are doing in India. And then a little later, apart from banks, NBFCs have come into picture, and housing finance companies are also there. So all of them are providing this product, popularly known as LRD. It is difficult to get a very precise figure of what is the current outstanding LRD product either in the banking system or elsewhere, for the simple reason that LRD is clubbed along with commercial real estate exposure for the purpose of various reportings. So commercial real estate exposure is a very broad subject. It includes all the loans availed by real estate developers for the purpose of developing projects, construction of new buildings, making layouts and selling, etc., etc. So LRD is one of the products which also gets clubbed along with commercial real estate. Commercial real estate is a fairly large exposure for all the three categories of lenders I explained to you, that is banks, NBFCs, and housing finance companies. To some extent, even the mutual fund industry may have some exposure here, but that's not expected to be large. So from that point of view, we don't have a very precise picture, but I can say that this is fairly large. It's fairly significant. So for us to understand how the LRD is affected by the current moratorium and also the business disruption that has happened, let us understand the few features of this LRD product. Here, the requirements are a well-located commercial property. A commercial property has been leased out. It is as a consequence of that rentals are coming and rentals are getting discounted. So the first requirement is a well-located commercial property. We must distinguish here between LRD and LAP, that is loan against property. I will come to that a little later. Currently, now we are discussing purely a rental discounting product where there is a commercial property and there are multiple reputed tenants. There are very few cases where the entire property is leased to a single tenant. There are such cases, but not very common. So if you have a large commercial property, most probably there are 3 or 4 or 5 tenants. In fact, I will come to the some details of this a little later. So obviously there are multiple tenants who have leased this property for various periods. Generally in India, the initial rental period is 3 to 5 years, and thereafter it's extendable by another 3 to 5 years. In some lease agreements, a specific percentage of increase in lease rent is provided. In many such cases, it is not mentioned, but it simply says that based on mutual discussion. So there is a lease agreement involving the lessor, who is the property owner, and the various lessees. Now, since the rentals are coming into the lessor, then the bank, what it decides is it will take into account what is the inflow of the rent on a monthly basis, because in all the cases the rentals are payable on a monthly basis. And then there are certain statutory deductions that happen. For example, there is a TDS that happens. So minus the TDS, which is currently 10%. So what is the rental amount that comes, and which comes over a period of 7 to 10 years, and the bank discounts that amount with whatever interest rates or discount factor they have and arrive at the loan amount. This can be for the entire building or it can be for specified tenants, because if all the tenants who are there are not reputed tenants and the bank is not certain about continuity of these tenants or regularity of payment of rents, etc., then they may select a few tenants and then arrive at the discount factor and then determine the loan amount. It's also important that the rent should be at normal rates which are prevailing in the market at that time, because if some specific tenant for some reason, because he wants to be in that particular building or in that particular location, pays an abnormally high rent, the bank will not take that rent into account for the purpose of determining the loan amount. It will take what is considered as normal, because in the event of this tenant vacating the premises, then the new tenant who comes should be able to pay the same rent. That's the basic principle. So on that basis, the discounting happens and the loan amount is determined. The banks also take into account, the lock-in period, because if the lock-in period is there, then it's an advantage for the bank, because during this period, the tenant is not permitted to vacate the building and he is mandatorily required to pay the rent. So this happens particularly where either a building has been specifically constructed or interior decoration or furnishing done for the purpose for which the tenant is going to use that premises. For example, if it is an IT company and the IT company requires certain plug and play type of interiors, and the landlord himself has done those interiors, then obviously he will expect the tenant to have a lock-in period. So that is an advantage where such loans are approved. Then the lease renewal, which I mentioned to you, which happens at the end of the initial lease period. So whether the renewal clauses are there is a mandatory increase in rent, etc. Because if there is a renewal clause with increase in rent, the bank also takes into account the future higher rent that is going to come for the purpose of determining the loan amount. Most of the lessees provide a lease deposit, which can be anywhere between 3 months to 6 months of the rental. This is also important. There are complications with this, which I will describe later. And then TDS, which is what happens. So that less tedious, whatever rent comes only is available to the landlord to use and for the bank to recover its loan. Normally, there is also an LTV cover. The LTV cover is between 50 to 60%. So that means if the property is worth, let us say 100 crores, the loan amount doesn't exceed 50 to 60 crores. So you decide the loan amount based on two eligibility factors. One is the lease rentals which are discounted for the period of, let us say, 7 to 10 years, which is also the repayment period. And the second one is the margin that the banks keep on the security value. This is based on the current valuation, which is generally taken as the distressed sale value of the property. Then there is a tripartite arrangement between the lessor, lessee and the bank. Obviously, this is required because the lessee should agree to pay to the bank directly. So there is an escrow arrangement. So all the rents will come and sit in that escrow account, and then the bank has got access to that escrow account, and then they will take away whatever installments are required for the purpose of their debt servicing. Generally, this is through an EMI process. So whatever money they recover, it includes both the principal as well as the interest. So management of escrow account to which the net rent flows is always with the lender. If it is an NBFC or a housing finance company, they set up this arrangement through a banker. So this is roughly what I will consider as the key characteristics of a rental discounting. So the same thing is there in the next slide by way of a pictorial presentation. Let us see the next slide. So now you can see here there is a bank which gives the loan to the lessor, and then the lessor has already leased the property to various lessees, and these lessees pay rent which goes to the escrow account, and then from the escrow account the bank recovers whatever its repayment is there. I said through the EMI process. Generally there is always a margin that is available, so roughly about 10 to 15% of the excess that is there in the escrow account is later returned to the lessor by the bank. This is roughly how it works. What is important here to note is that even assuming that some tenant or lessee has not paid the rent on time, generally the escrow has some cushion mechanism because there is a surplus rent, so it gets adjusted. Some banks also put what is called a DESRA. The DESRA is the retention account where some surplus amount is always available for debt servicing. So DESRA is debt servicing retention account. So this amount that is there can be dipped into if necessary. If for any reason the lessees don't pay to the escrow account on time, sometimes lessees also by oversight or otherwise pay directly to the lessor. So there is a shortfall in the escrow. So this type of problems are generally taken care of by having a DESRA account. Otherwise, this is a fairly simple, straightforward loan transaction. That is why we call this as a structured product or a structured loan. The reason for us to call this as a structured loan is that here the lessor's financial strength or balance sheet strength, as we call it, which is generally measured through numbers like, for example, paid up capital, net worth, gearing ratio, that is total borrowings versus net worth, liquidity ratios like which is determined through the current account. So these are not very important here. So what is important is the manner in which the structure operates. That means are the lessors is the lessor having a property which is valuable? Answer is yes. Are there reputed lessees? Yes. Is there a tripartite arrangement? Yes. Is the loan amount determined based on the discount factor on the rents receivable? Yes. Then whether the escrow mechanism has been set up in place so that the bank has got control over the escrow cash flows? Yes. In which case the loan is approved, because the lessees have no choice than to pay rent on a monthly basis, because if you default, then obviously the lessor is going to ask you to vacate the premises. So that is not going to happen in most cases. So the bank has control over the escrow. They are in a position to recover themselves. So it whole thing works like a clock. Like this is how it has been functioning all these days, and that is why this product is quite popular with all the lenders. Now let us see what has happened post-COVID situation. Let us go to the next slide. Now, what has happened as a consequence of the COVID, which I mentioned to you in the beginning of my presentation, is that everybody's business has been impacted. Some certain types of businesses are more impacted than others, but practically there is no one who has not been impacted. Now, I have listed out a few things that are happening here. Basically, let us consider two different types of properties and how they are affected. First type of property is what is called an office space. An office space is one where the lessees are generally commercial establishments. It may be that means the tenants. It may be banks, NBFCs, insurance companies, IT companies in a city like Bangalore, Chennai, Gurgaon, Hyderabad, etc. These IT companies are very big, tenants. So in most cases, they don't own properties. They may have one or two, properties of their own, but many other properties are, are leased out, and so they are there for long term, and they also pay good rents. So they are very popular tenants among the office space builders. And then some here and there are some cases where corporate offices or offices of overseas entities are also located. So this is one type of property, that is commercial property, office space with tenants like this. The second one, which is also equally popular, are the malls. Now this India is now very firmly entrenched in this mall culture, at least for the last about more than 10 years, in some cities for more than 15 years. So these malls are very attractive, large buildings, generally of 3 to 4 floors, large parking space. Generally in the ground floor, you have got anchor tenants, ground floor or maybe even the first floor. The most popular anchor tenants I see are the ones like Lifestyle, Pantaloons, Tata Group, retail shops, Reliance Group, Future Group. So this type of people are all located in the ground floor or the first floor, and these are called the anchor tenants. Most of them sell retail products, including textiles and things like that. And then in the topmost floor, generally you see in all the malls cinema theaters. These are multiplexes. There is also a food court close by. And then in the other floors, you have got various tenants. Some of them are large tenants, some of them are medium size or smaller tenants. So these are the two distinct properties where the LRD product operates. So let us see how the business of each is affected. So now what is happening is, with work from home culture coming in a number of businesses, particularly the IT business, nowadays, what is happening, nearly 25 to 50% of their workforce are working from home. Currently, it may be the percentage may be higher. In fact, in Bangalore, if I look at today, nearly 75 to 80% of the IT companies' employees are working from home. So only 20% people are working close to the office, who stay close to the office are coming to the office, and then they are coming by rotation, etc. That means nearly 75 to 80% of the office space which they were occupying earlier now remains unused. So many companies who have leased out properties are now saying, now why do I require such large expensive office space? They are paying rent, they are providing the various facilities there, the building is air conditioned, power expenses are there, they have to provide canteen facilities, transportation facility for the employees. So though work from home was there earlier, maybe 10% or 5% people are working from home. Today, nearly 75 to 80% people are working from home. Even after the pandemic goes away, let us say by December, the expectation is that probably they will all feel that not more than 50% people are required to come to office. That means the present office space which they have hired has remained unutilized, and it's quite possible that they will say that I don't require this space, I'm going to surrender the lease, subject to whatever terms and conditions are there in the lease agreements. Second, many lessees are vacating the premises and lessors are unable to find new tenants. This is happening where the lessor says, the lessee says, no, I have difficulty to pay so much of rent, so some premises I am vacating, a certain percentage of the premises I am vacating. So without waiting for further development, they're already vacating the premises. And then the vacation happens, the landlord is unable to find another tenant to move in quickly. Because what happens is, the moment the lessee gives a notice of vacation, then to that extent he stops paying rent. He will say, whatever lease deposit I have provided, please use that, to adjust the rent, till I vacate the premises. And so the rental inflow stops more or less immediately. So that is exactly what is happening. So the lessees have problems because they are not able to pay rent. Lessors have got problems because they are unable to find new tenants. In respect of malls, in most cities, either the malls are closed or operating with severe restrictions. In fact, in many major cities, for the last 3 months, the malls have not opened because it is felt that the malls are prone to higher degrees of risk. Number one is the footfalls could be higher. Number two, maintaining social distancing, etc., is a problem. And number three is that there are centrally air conditioned, so there is a feeling that in that air conditioned atmosphere, the pandemic may escalate. So as a reason of all these things, many cities have closed their malls, and in some cities where they have just opened, what I understand is that people themselves are very cautious. They are not going there. So the footfalls have significantly fallen, and then so for all practical purposes, these malls are in stress. Now the cinemas and food courts, in most even in those cases where the malls are functional, are not allowed. Now, as a consequence of all these things, what has happened? The lessees who are tenants in these malls have lost revenue for all the practical purposes for the entire 3 months. And even if they have opened, they are hardly transacting 10% to 20% of the business what they did. So, which is not even sufficient for them to meet their establishment expenses. So, that's the problem there. So, tenants are asking for a host of concessions or waivers. In fact, in many cases, the tenants are saying, if your mall is closed and I am not able to do my business, you have not given me a property which is useful to me for my business, and so I am not required to pay you any rent. So that is the type of stand some people have taken, or in some cases people have said, no, give me some concessions. So I will explain this a little later. So as a consequence of all this, the inflow into the escrow account has become extremely small. It is hardly 20% or 30% of what was coming earlier. Of course, some corporate tenants may still be paying the rents, but many others are not paying. So as a result, the escrow account doesn't have the required inflows. So the money required for the purpose of debt servicing is not forthcoming. Of course, today moratorium is there. So even if there is shortfall, etc., it's not such a big problem as of now, because nobody is forcing a lessor to pay the loan if he has availed the moratorium facility. So as of now, this is not resulting in an immediate problem of the loan being classified as a defaulter or NPA or whatever it is. That's not happening. But the main assumption behind which the LRD was sanctioned is all affected now. Let us go to the next slide now. So the most LRD borrowers also have availed moratorium, as I explained earlier. So from that point of view, at least till August or September, immediately problem is not there. Though as of now, we must all understand that the interest meter of all the lenders is running. So interest is getting accumulated. Only thing is you are not being called a defaulter because you have not paid the loan. That's number one. Number two, in office space situation, I have not come across cases where any defaults have happened. So the large corporates, including IT companies or banks or insurance companies who are tenants, they're all paying rents, so that's not a problem. But most of them, are now in discussion with the lessors about vacating fully or partly some of the space that they have occupied. The reasons for which I have mentioned, and alternate lessees obviously are not visible in the current situation. So probably in 6 months' time, you will see a lot of vacant space in those buildings which have been occupied and run for several years now. So this is the problem. And new leases, wherever they are forthcoming, are getting signed at much lower rents. One estimate is that it is about 15 to 20% lower than the rents which were being paid earlier. That means the assumption that the bank had done about the inflow of rent, even if occupancy improves, it will get reduced to that extent. In malls, I have explained the problem in detail. So recently, the DLF in the Delhi Gurgaon area has entered into certain agreements with their tenants. So this is very interesting. This is only an example. I have not come across public information about the problems of other malls. For example, if I take Gurgaon itself, Ambience Mall is a very big mall there. DLF has its malls. In Bangalore, you have got Forum Mall, Mantri Mall, and Phoenix Mall, which are all big malls. And then in various other cities, Phoenix malls are there. So in these cases, what is going to happen, what type of negotiations are happening is not clear. Though we all know that this retail, the big retail giants, including people like Future Group, etc., have already spoken to the various landlords saying that we need to renegotiate the terms. Now, in this case, in the case of DLF, what they have reached out with the tenants is that they have said that, yes, I understand your problems. So they have waived rent for the lockdown, total lockdown period. So that's one thing they have said, because maybe DLF feels, they need to have a good relationship with the tenants. Otherwise, they will all vacate and they can't find new tenants. And anyway, the premises will remain vacant. So instead of that, why don't you have this arrangement with the existing tenant himself? So for a couple of months, they are waiving the rents, and later they have put graded rents. So let us, for sake of argument, let us say if 10 lakhs is the rent per month. So they have said that once the mall has opened, first 3 months you pay only 25%, that is 2.5 lakhs. Next 3 months you pay 5 lakhs. Next 3 months you pay 7.5 lakhs. Thereafter it becomes 10 lakhs. Is an example. Now this is the type of, because DLF probably has much less borrowings, so it may be in a situation where they may not have availed an LRD or whatever it is. Even if they have availed, it may be a small amount. So they are not they are not badly affected in terms of debt servicing, etc. There may be other issues. So they have reached out to the tenants and then worked out or renegotiated their rental agreements to keep the tenants happy and continue them in the premises and not make them exit that premises. That's what they have done. I am sure something similar is going to happen elsewhere. Pressures are going to be put by all particularly the big retailers. If you take the names I mentioned to you earlier, like Lifestyle, Future Group, Tata's, Reliance, etc., they are there in multiple cities, in multiple malls. So they are going to put the same type of pressure everywhere, and this is going to create problems. This is number one. The other point is that the rent, which was earlier fixed rent, may become a revenue sharing model, in the sense that part of the rent will be fixed, part of the rent on a revenue sharing basis. This is already there. It's not that it is not there, but the point is that the fixed portion will come down and revenue sharing portion will go up. That means there will be uncertainty on the monthly rent, because it all depends on whether people go to the malls or not, and then if so, whether what really they buy there. Will they really go to the cinema theaters? Will they go to the food courts? So when everything becomes a revenue sharing model, you don't know what really happens, and there will be total uncertainty on the monthly rentals and the amount that flows into the escrow account. So now, as a consequence of this, the current outstanding loan amount, it might have already come down from the beginning, but now whatever amount is there, whatever EMI is there, the amount in the escrow account is not sufficient. And if somebody were to rework based on the current cash flows, what will be the loan amount? That may be much lower than the current outstanding amount. So this removes the characteristics of the structured nature of the loan, where earlier the whole thing was fixed based on these criticalities, including the rental amount that flows into the escrow account. Now that has been broadly affected. Now let us see what could be done to handle this problem. So let us go to the next slide. So most lessors, that means the property owners, if they have got other businesses or assets, one thing that the bank can ask is, now why don't you reduce the loan amount by bringing in money from those cases. For example, if let us say, I just give the example of DLF. If DLF has put up this particular building, this is not the only business they have. Most of the landlords are real estate players. They have got a lot of other businesses. There may be money available elsewhere. There are assets which can be liquidated and money can be brought in. So one thing that they can tell the bank is, okay, now you are now saying that based on the reduced rental, the loan amount, let us say, comes to 100 crores, whereas my outstanding loan amount is say 175 crores. Whether I can bring down that 75 crores and reduce the loan amount so that the outstanding loan amount now can be serviced by whatever reduced rent I am going to get. This is one thing that can be done, particularly where the landlords are resourceful. So in many cases, it's possible for them to do that. As they can, since they have brought down the they have reduced the loan amount, then the existing rent itself is sufficient. The other point is, okay, now there is a shortfall in a monthly debt servicing. I cannot bring a lump sum amount, but I will bring the amount that is required to match the shortfall. Let us say now for this every month, let us say the installment is say 5 crores, the EMI is 5 crores, whereas now I am getting 3.5 crores. So there is a shortfall of 1.5 crore. That 1.5 crore can the landlord bring in from other sources of his income. So that is the second point. The only point we have to understand here is an element of uncertainty will come in on a monthly basis, because we at the time of granting this loan, the bank has not really evaluated his various other sources of funding, his ability to bring in money on a monthly basis with regularity. So that has not been assessed. The bank has simply gone by the amount that is likely to be available in the escrow account based on certainty of rentals. Now, since that there is a shortfall there, and this shortfall is to be made good by the landlord on a monthly basis. Now the bank is required to assess whether that ability to bring in on a monthly basis is there. If so, whether I can agree for that. But we must all understand that the structured nature of the product gets affected as a consequence of this. If both of these things don't work out, that is, neither he is able to bring in the shortfall on a monthly basis, nor he is able to bring in a lump sum amount to reduce the loan amount itself, then you have to go for total restructuring of the loan. There are various regulatory guidelines that are there for restructuring of loans. This is definitely a good situation where restructuring can be helpful, because it's the borrower's inability to pay is based on factors beyond his control. So obviously, the banks, I think, will take a more sympathetic view and then do this. And then banks, going forward, banks are likely to be less enthusiastic about LRD as a product, because this was considered to be a very safe product. In fact, most of you may recollect that for all loans in general, the end use of funds of the loan is an important point. What you will do with the loan amount? This is a question which banks will ask, and then they will also ensure that the money is used for that specific purpose. Now, in this case of LRD, the banks have not done that exercise, because they know that okay, this guy is in some business, and whatever money is used is availed through LRD, he will use it for his business. So they have no responsibility for ensuring what he does with the money. So this is one such product. Normally in all loans, you have to take the money for the specific purpose. If you take a loan for a machinery, that the money has to be used only for buying the machinery. If you take a loan for building a let us say commercial space, then you have to use it only for that purpose. But what you did with the LRD, banks have not asked. But now I think because they're dependent on the of the loan. Now that has been affected. I expect that the banks will be less enthusiastic about LRDs because of the uncertainties of rents, etc. Though the property value may be there, because the property value may or may not have dropped too much. Even if I look at the various reports, at best the property values might have fallen by 5 to 10% in various cities. So the LTV drop itself is not a big issue as of for the banks today. What is important is that the debt servicing is not happening because cash flows are not forthcoming. That is the issue today. So that problem is going to persist until the whole uncertainty about tenants, rental repayments, rental payments to the escrow account, etc. That problem is resolved. Until that happens, I don't expect banks to be enthusiastic about future LRD. So one good product that was there, which all lenders were enthusiastically embracing, is likely to be given a cold shoulder at least for some more time. This is what I thought. So I think this is basically, my take on LRD as a product. So I'm sure all the both the borrowers, and the banks and the lenders will take these aspects in mind and then review their portfolio and see what are the steps to be taken. Thank you very much.
Yeah, thank you, Mr. Manjunath, for this insightful session. Well, at this stage, I would like to just draw your attention that these are expert sessions which we are having across various sectors. If you have any queries regarding the topic which was discussed today on lease rental discounting, feel free to reach out to us at our email address, that is investordesk@brickworkratings.com. I'm again repeating, it is investordesk@brickworkratings.com. We'll be happy to answer all your queries and also help you to connect with Mr. Manjunath for any other insights or information you require. As promised, we'll be bringing in a lot of videos on this. These videos will be available on YouTube as well. So subscribe to our channel. You can see the subscribe button up here. You can subscribe and get notified on new videos, new sessions, new expert views, and help you to gain insights about what's happening in the market. Because today the market, and especially the economy, is at a fast-pacing change. So to get abreast with what's happening, it is very important to hear from the experts, which we just heard from Mr. Manjunath on this topic. So with that, I would like to thank Mr. Manjunath and thank your attention. As I said, feel free to reach out to us and subscribe us. Thank you.
Thank you.